My name is Todd R. Yarbrough. I am an economics professor at Purdue University here in beautiful West Lafayette. And the reason we're here is to just talk and educate on economic ideas. Vice President J.D. Vance came out this week and echoed what President Trump has been saying with respect to Federal Reserve policy, monetary policy. And in particular, their contention that the correct path forward for monetary policy would be to lower interest rates. Let's first start out from the position that the Fed doesn't control interest rates in the economy. Beyond the Fed does have this one interest rate called the discount rate. That's the interest rate that they charge to banks who take out loans from the Fed in what we refer to as the overnight window. Banks sometimes have to close gaps in terms of their liquidity, and so they take out loans from the Federal Reserve. And so the discount rate is the interest rate that banks pay to the Fed. That ends up affecting what we refer to as the federal funds rate. The federal funds rate is the interest rate that banks pay to each other, so that commercial banks pay to each other. That's a regulated rate. So the idea is that if the Fed wants interest rates in the economic system to generally trend up, they're gonna move that discount rate up. So now banks have to pay higher interest rates to the Fed. They in turn are going to turn around and increase the interest rates that they charge to each other. And then the cascading effect is going to be that then credit card interest rates, variable rate stuff's going to go up, mortgage rates are going to go up. So when we say that the Fed is increasing interest rates or decreasing interest rates, really what we mean is that the Fed is targeting higher or lower interest rates. They are trying to move interest rates in the economic system either up or down. And really simply, we can think about, moving interest rates up as contractionary monetary policy. You're trying to reduce spending in the economy by making, interest payments higher. Which is supposed to discourage spending, discourages investment, sort of cools the economy off, as it were. Or the Federal Reserve can have expansionary monetary policy. So that would be targeting lower interest rates to encourage spending, to encourage investment. Now, traditionally, you pursue expansionary monetary policy when you're in recession, because you need to kind of boost the economy. During recession, people they don't spend money because some of them lose their jobs, and then even the ones who don't lose their jobs, they don't spend as much money because they're worried because they notice their neighbor lost their job and this other neighbor lost their job. So I start saving, right? So spending declines during recessions. And this is problematic because our economic system is in many ways moves due to expenditure. And so one of the things that we can do is we can buoy expenditure through expansionary monetary policy. And again, the sort of mainstream economic viewpoint is that you pretty much want to do this when the economy is not at the growth rate you want it to be. So when you want to grow the economy faster than you currently are, you're going to run expansionary monetary policy. On the other hand, if you want to cool the economy off and or you're trying to fight inflation, then you want to target higher interest rates, which is going to bring spending down and should take off some of that pressure in the economic system. One of the things that I don't think that the general population necessarily knows is that you don't want to just try to run your economy as hot as possible, to just grow it as quickly as possible. We actually know that that is a very bad idea. And one of the biggest reasons why that's a bad idea is that pursuing that sort of policy path almost assuredly is going to create a lot of inflation, and so much inflation that eventually it will, in fact, offset the gains that you were trying to generate by expansionary policy. So now, going back to the current situation. So again, Vance joins the Trump administration's chorus of basically saying the Fed should be targeting lower interest rates. So their argument is the Fed should be trying to boost the economy from where it is currently. Now, let's just sort of talk about that in the historical context of what we generally consider good monetary policy. We have come to see monetary policy as really an adjustment mechanism that basically responds to whatever's going on in the economic system and then focuses mainly on inflation and then unemployment. So the Fed kind of over time has become really an inflation monitor and an inflation manager, if you will. Now, in the late 70s, 1978, Congress actually passed what we refer to as the dual mandate. So the dual mandate tasks the Federal Reserve with two things, right? Low stable inflation and low unemployment. Now, there's always been some debate as to which of those two things should the Fed focus on more. Can the Fed focus on both simultaneously? The thing about inflation and unemployment is that they typically have a relationship with each other. Most notably, if unemployment goes up, then inflation goes down. So when the economy weakens, you get less spending, you get less inflationary pressure. And so if the Federal Reserve wants to fight inflation, if they want to cool off the economy because they're worried it might be running too hot, they can target higher interest rates. And so the effect of that is it's going to put downward pressure on spending. And again, the point of this would be we want to kind of keep inflation in line with particular targets. So the Fed kind of targets an inflation rate and then achieves that target inflation rate nowadays primarily through interest rate policy. Again, targeting higher or lower interest rates depending upon what they think they should be doing for the economy. So just as a real quick example, if you go back to the COVID pandemic, of course, everything shut down in the economy. We essentially entered a very short run economic depression, and the Fed responded as we would typically expect them to by basically targeting very, very low interest rates to the extent that the discount rate and the federal funds rate effectively went to zero in 2020 and into the beginning of 2021. And of course, the idea there was we're gonna keep the economy going despite the fact that people have lost their jobs. And so that's expansionary monetary policy being run specifically to keep the economy moving in the right direction and not sort of take too much of a step back. In a sense, the benefit of running expansionary monetary policy during a time of economic weakness is that you get to boost the economy, and it doesn't necessarily generate that much inflationary pressure. Now, what happened, of course, in 2020 and 2021 is that on top of expansionary monetary policy, we also had expansionary fiscal policy. And that does the exact same thing. It puts upward pressure on spending. So we had upward pressure being put on spending from both the fiscal policy side, the government increasing government spending, fiscal stimulus, as well as the monetary policy side. This was very successful, by the way. So just from a policy standpoint, of the point of those expansionary policies was to boost the economy, to basically keep it at a level and keep it from falling due to the COVID pandemic. And frankly, as an economist, in hindsight, like if you were told me right when the COVID pandemic first happened, this is what's going to happen to the economy, this is how much of a crunch is going to be created by the COVID pandemic, and then even if you told me what the policy was, I probably would not have predicted that it would have worked as well as it did. The major consequence of these policies, however, was this immense inflationary pressure, where inflation in the U.S. rose up to 10%, which was the highest inflation we'd had since the early 1980s. Basically, the highest inflation we've had since the stagflation era of the United States, which is the mid to late 1970s. An era where, again, going back to this relationship between unemployment and inflation, you had both high unemployment and high inflation. And really, that only happens when your economic system is in extreme dysfunction. And very often that happens because of a combination of some fairly random kind of economic shock. COVID. In the 70s, we had two substantial oil price shocks. We think about these as negative supply shocks. Basically, everything became more expensive. It was very hard to find gasoline at times. And so this pushed, basically what the economy could produce, it decreased it. And when you decrease the amount that an economy can produce, this also puts upward pressure on inflation. So the two reasons why you get inflation is your economy is growing in terms of spending, but the supply is staying relatively the same, so that puts upward pressure on inflation. Or the spending is staying relatively the same, or in fact being pushed up, while the supply is being crimped due to like oil price shocks in the 70s or the COVID pandemic messing with supply chains. And so monetary policy has to be very attuned to what's going on in the economic system in order for it to carry out good policy. And then, as equally as important as to the Fed's need to have good understanding of what's going on in the economy, the Fed also needs to have, and this is something that economists have come to believe very strongly, the economy, the central bank needs a clear set of incentives, a clear set of motivations, and they need to signal these motivations. They basically need to tell markets, this is how we see the economy, this is what we think we should be doing, and this is what we're probably going to do in the future. And essentially what the Federal Reserve has been doing for the last 30 years has been telling, we are going to manage inflation. We are going to keep inflation in line when things are good, and then when things are bad, we will pursue expansionary monetary policy to try to keep employment from falling too much. And monetary policy has been, I would argue, borderline wildly successful, especially since the early 2000s. The extent to which the U.S. economy has grown, and also grown during relatively turbulent times, right? Recession in 2001, recession in 2008, 2009, and COVID, pandemic, and we came out of that right here in 2024 or beginning of 2025 with 4.1% unemployment. That's historically low unemployment, and 2% inflation. That's historically exactly at the inflation target. If we're talking about what the Fed has typically set as its inflation target, it's around 2 to 3%. That's about the inflation we want. We don't want more than 3% inflation. That means you're probably overcooking your economy, or there's some sort of supply chain problem. You don't want less than 2% inflation, because that means your economy is not growing. That means people are not spending money in your economic system. And so Federal Reserve, nowadays is really about kind of just keeping inflation within that particular target, especially during good economic time periods when the economy is expanding, as it has been, since 2022. In part, the economy expanded since 2022 because of the expansionary fiscal and monetary policy. But of course, if you go back to 2022, late 2022, early 2023, what do you see? You see the Federal Reserve increases interest rate targets because we had that 10% inflation. So the Fed is fighting inflation. They are pushing up interest rates. The point of this is to reduce spending in the economy. And the net result of that was we got much lower inflation, and we did not really increase unemployment very much. We went from, I think, around 3.6% unemployment to about 4% unemployment by the end of 2024. I mean, that's an increase in unemployment. However, that also got us much less inflation than we otherwise would have had. So again, very, very good, really, in terms of monetary policy. So for the current administration to first off kind of disagree with the idea that the Fed has been doing a good job, that really doesn't make a whole lot of sense. Just the numbers tell us the Fed is doing a good job. I mean, the Fed is tasked with literally two things, right? Low stable inflation, check. Low unemployment, check. So if we just grade the Fed on literally what we've told them to do, they have done that very, very well. And understand that I'm an academic. Jerome Powell was not someone I was necessarily excited to be Fed chairman. He's not an academic. He's sort of an industry person. I was very wary of him as Fed chairman, but I think he's done an amazing job at listening to the other folks on the Federal Reserve, and ultimately the policy has really just been solid, to say the least. I mean, to be honest. But then there's like this other part of the story that is in many ways strikes more at the heart of kind of basic economic principles, because there's sort of debates over monetary policy. I mean, you could find economists who maybe don't think that the Fed has done necessarily a stellar job. Maybe they think it's been a mediocre to even bad job. There's not a lot of them, but you could certainly find them, and I would respect their opinions if they wanted to debate me on that particular point. And there's certainly some criticism that can be leveled at any time with large institutions such as the Federal Reserve. But the one thing that nobody would disagree with, I don't think, at least no modern trained economist, is that the Fed should be independent of executive of congressional decisions. That there should be no influence on Federal Reserve policy coming from the political class at all whatsoever. I have criticized politicians for years now for really even commenting on monetary policy. It'd be much better world if politicians just didn't even really talk about monetary policy, other than to say, hey, the central bank's doing a good job when they're doing a good job, or if the central bank's not doing a good job, say the central bank's not doing a good job, but be prepared to back it up with actual data. So let's go back in time a little bit. So there'll be a little bit of a history lesson here, and let's ask ourselves, why is Fed independence so important? Do we have a reason to believe this? Do we have an example in the past of when Fed policy was not independent, and did that go poorly? And the answer is, of course, it did. So if we go back to the late 1960s, Richard Nixon wants to be elected president, and he has these scars from the first time he lost a presidential election to Kennedy back in 1960. And he blames the late 1950s recessions on his loss because the Republican was president. There were, I think, 3 recessions in the span of about 4 years in that last administration. And Nixon thinks that's why he loses the election to Kennedy, is because people didn't trust the Republicans on the economy because there had been so many recessions. Nixon is like really, really well aware of this. So when he gets into office, he immediately starts to pursue very, very pro-growth policies, very sort of expansionary fiscal policy. We had, by the way, already a substantial expansionary fiscal policy in the 1960s. You had the Kennedy tax cut, you had the Johnson War on Poverty, you had the Vietnam War. All of these things are putting upward pressure on spending in the economy. All of these things, by the way, ultimately are also putting upward pressure on inflation. Again, but the Fed is supposed to be there to move against inflation. Nixon is like already worried about the next election in 72. He's already worried about his reelection chances. And the thing that he cares most about is basically juicing the economy. He wants to ramp up economic growth as much as possible. He thinks that is the key to his reelection. As a part of this, Nixon specifically appoints Arthur Burns to the chairmanship of the Federal Reserve. Arthur Burns was a friend of Nixon. Arthur Burns had been a prominent sort of Republican attached economist, had sort of espoused, generally held sort of like Republican economic beliefs, fairly conservative free market beliefs, being very sort of pro-growth. So Nixon brings him in. Nixon expects Burns to do what Nixon wants, which is that Nixon wants to do expansionary fiscal policy, wants to really blow out spending, and then he wants the Fed to either keep interest rates the same or in fact cut them. He wants expansionary fiscal monetary policy on top of this. Burns actually is reticent to do this because Burns is actually an economist, and so Burns knows, hey, if we're doing all this spending and we run low interest rates, like that has to increase inflation. That's probably not a good idea. Nixon basically takes to the press, although covertly, and starts putting stories in newspapers about Arthur Burns and being very, very negative, attacking Arthur Burns personally, calling his intelligence into question. This may seem familiar to you. And so ultimately, Burns acquiesces. And we run expansionary monetary policy at the beginning of the 1970s. And so then the U.S. economy has this immense inflationary pressure in the early part of the 1970s. Nixon gets reelected. The central bank continues to pursue expansionary monetary policy. The executive branch continues to pursue expansionary fiscal policy. So then we get into, of course, when Nixon's downfall and the whole Watergate and everything, and he bows out, and then Ford takes over for Nixon, the U.S. economy is like on the precipice of an inflationary event. And then we get a kickstart to that event, and that is the oil price shocks of the early 1970s. So it's like 73 to 74 to 75. You had political unrest in the Middle East. You had embargoes on Middle Eastern oil as a result, and so there was this severe oil supply shock in the U.S. economy. The initial effect of that is going to be inflationary pressure. So we already had inflationary pressure from policy. We then had even more inflationary pressure due to the supply shocks. So really, really high inflation in 1974-75. Also, by the way, a recession induced by those supply shocks. We go in, we continue through the 1970s, we continue to have expansionary monetary policy, despite the fact that we had high inflation and it really wasn't going anywhere. It was sticking around. We had persistent inflation. This is when we really start to think that inflation has inertia and that inflation is very expectations driven. So if I think there's going to be inflation, it sort of causes inflation in a way. This is why we now think monetary policy has to be stable, clear, and perceptible. People have to know what's going on because they have to create those expectations, and we don't want people to expect there to be runaway inflation. And that's what started to happen in the 1970s. There was then another oil price shock at the very tail end of the 1970s, which further pushed up inflation. And of course, because these were supply side issues, they also coincided with increases in unemployment. This is the stagflation era of the United States, and the stagflation era, not just the United States, but other parts of the world as well. It is true that it's not just about Nixon policy and Arthur Burns' Federal Reserve policy. It's also about those supply shocks. But the requisite self-interested policy of the Nixon administration, coupled with self-interested policy carried out on behalf of the Nixon administration by Arthur Burns' Federal Reserve, absolutely led to the full extent of the inflationary effect in the United States. So the big thing that we came to learn from that is that presidents, Congress, people who want to be reelected in the future have very perverse incentives when it comes to monetary policy. So instead of monetary policy being there as a check on the inflationary pressure being generated by profligate spending on the executive side, on the congressional side, instead it becomes simply a cheerleader of that policy. And so when Fed policy becomes too wrapped up in fiscal policy and becomes too what we call accommodating, the results have been disastrous. We feel very strongly, therefore, that the Fed should be completely independent from the political process. I mean, we even worry just the fact that the president appoints the Fed chairman. We saw with Nixon the potential ramifications and effect on that. So with Trump and J.D. Vance, again, sort of getting personal with their criticisms of Fed Chairman Powell's policy and the statements he's made recently with concerns over high inflation and potentially high unemployment due to uncertainty, partly due to tariffs, but also just that, the U.S. economy has been weakening in some sense naturally. So, there was a weakening of the economy that happened, before the Trump administration came in. And then since the Trump administration has come in, there's been this great increase in uncertainty. So the sort of weakening of the economy then coincided with all this uncertainty. And so the Fed is really caught in a position because the uncertainty also could cause inflation. And so the Fed needs to be ready to fight inflation. But if they go to fight inflation, they're going to do so with higher interest rates. And this is going to cause, there to be downward pressure put on spending. Trump doesn't want this. So I think that if I had to try to look into the crystal ball here, I think that Trump perceives there to potentially be inflationary pressure coming down the pike. And therefore, he's worried that the Fed is going to respond to that by increasing interest rates. And then the net result of that is that the boost he's seeking in the economic system through his own fiscal policy, right? Because the budget that was passed recently by the GOP House was an increase in spending. It was in many respects a fiscal expansion. And so Trump doesn't want the Federal Reserve to get in the way of that. And history says that's probably a really, really bad idea. And it wouldn't matter who the president was. If a Democratic president did this, I would be saying the exact same thing. And in fact, look forward to what I expect to be a future of both sides of the political aisle being way more opinionated about monetary policy. So I stand at the ready to criticize them.